Hello, and thank you for joining today's webinar, Pre-Retirement Perspectives on Social Security, What You Need to Know and Do Before You Apply, with HBKS Wealth Advisors partner and senior financial advisor in our Erie office, Rinn, CFP, and Social Security consultant, John Johnston. Before we begin, let's review a few housekeeping items. First, at the bottom of your screen, you'll notice a toolbar with multiple tools you can use. All of the engagement tools are resizable and movable, so you're welcome to move them around to get the most out of your monitor space. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner. If you have any questions during the webcast, you can submit them through the Q&A engagement tool. We will answer these questions during the webcast, but if we run out of time, you will be answered later via email. A copy of today's slide deck and the links that John will be referencing during his presentation and additional help materials are available in the related content tool. In addition, we encourage you to download any resources or links that you may find helpful. For the best viewing experience, we suggest closing any programs or browser sessions running in the background that could cause issues. You can also find additional answers to some common technical issues in the help tool at the bottom of your screen. We value your feedback, and once you leave today's webinar, you will receive a survey on the session. We would appreciate you providing your feedback. You will also receive a follow-up email within 24 to 48 hours with a link to review the session that we record today. At this time, I'd like to turn it over to Steve.
Thanks, Lori, and good morning. As Lori mentioned, my name is Stephen Rinn. I'm a partner in the HBKS Wealth Advisors Erie office. It's my pleasure to introduce John Johnston. John is going to lead us through his presentation on Social Security and Medicare this morning. Myself and others within HBKS have worked with John for the last 15 plus years in assisting our clients with their planning related to Social Security and Medicare. Just a little background on John. He's educated in Pennsylvania colleges. He earned a master's in public administration and spent 26 years working as a public affairs specialist for the Social Security Administration. John has a long history of working directly with financial groups like ours on technical and complex Social Security Medicare planning issues. So John's recently retired from his position with Social Security Administration, I think December of 2021. John's retirement, we've continued to work with John as a consultant. John's been and continues to be a very valuable resource for our client base when it comes to their planning. If you have any questions about your planning or your own benefits or information related to John's review, please feel free to reach out directly to myself or another member of your HBKS team. We're happy to work directly with you, utilizing John's expertise to assist with planning questions. With that, I'm going to turn it over to John and let him do his thing.
Thanks for the introduction, Steve. Let's jump right into this. We have a lot to cover in this hour, and I'm hoping that we can get to some questions at the end of this. So, Social Security is funded through taxes that you pay out of your paycheck, and those taxes are called FICA taxes. That stands for the Federal Insurance Contributions Act. It also may show up on your paycheck as OA-SDI. That's Old Age Survivors and Disability Insurance. That's what that acronym stands for. Social Security is huge on acronyms, too. You'll see acronyms all over the program. And essentially, that payroll tax comes to 15.3% of your gross wages. It's broken down that you pay 6.2% for Medicare, you pay 6.2% for Social Security, 1.45% for Medicare, okay, and then your employer matches that. If you're self-employed, you pay the whole thing, and the FICA taxes are what funds the Social Security retirement, disability, and survivors benefits. So if you ever wondered how Social Security is funded and how we've been funded since we started in 1935, that's how Social Security works. That's how it's funded. How do you qualify for retirement benefits? One of the acronyms that I talked about is insurance. They say old age survivors or disability insurance. And at Social Security, we talked about it like an insurance program that you are working and paying taxes, which is like paying a premium on an insurance policy. If you pay enough, you become insured for different benefits. So how do you qualify for retirement benefits? You need 40 credits, or 40 quarters, some people will say, 10 years of work, and you must be 62 years older, 62 years or older. In 2022, for every $1,510 you earn, you'll earn 1 credit towards being insured with Social Security. You can earn a maximum of 4 credits per year. So most of us are insured for our retirement benefits pretty early. I was insured for my retirement benefits by the time I was 26. Okay, I'd started working when I was 16, so I had my 10 years worth of work, my 40 quarters in by the time I was 26. So pretty easy to get your foot in the door. You get those 10 years worth of work, 62 years old, you can file a claim. Now, if that's all the work you've done, if you've just done those 10 years worth of work, you'll be able to collect a benefit, but your benefit is going to be very low. Okay. How we determine your benefit, we look at all your earnings for your entire lifetime. Okay, so the first job that I got was in El Paso, Texas. I lived in El Paso, Texas when I was going to high school. Very hot in El Paso. We had days straight of over 100-degree weather. My parents had a pool. They would open that pool in March, and we wouldn't close it till the end of November. Anyway, I was a resourceful kid back then. I got a job scooping ice cream, and I earned $2,550 in 1985. That still shows up on my Social Security statement. So when we're determining your benefit, we look at all your earnings for your whole lifetime. We adjust those earnings for inflation. So if I'm lucky enough to make it to my retirement age, that $2,530 that I earned in 1985, that might be worth $10,000. So again, we look at lifetime worth of wages and we adjust it to inflation. Once that's done, you take the highest 35 years. So even though you only need 10 years to be insured, if that's all you've worked, when Social Security computes your benefit, you're going to have 25 years worth of zeros plugged into that equation. So you want to have 35 of the highest possible years to maximize your benefit. One of the common questions that I get asked is, how do I maximize my Social Security benefit? And the real way to do that is to work as much as you can and have a high 35 years. If you've worked 45 years, we're going to drop your lowest 10. Okay, so if you've worked over that amount, we're going to drop your low years. Once Social Security determines your high 35 years, they add them together, sum it, and average it out, and that's what is referred to as your average indexed monthly earnings. That's the average of what you earned during your lifetime on a monthly basis after it's been indexed for inflation. Okay? From there, they run it through a benefit formula. And here's an example of the 2022 retirement benefit formula. This does get a little bit mathy. Okay? In this example, I took a person whose average monthly earnings would be $7,000 per month adjusted to inflation. Their benefit at their full retirement age is going to end up being $2,693. And how they get to that is you get 90% of the first $1,024. So everyone gets 90% of the first $1,024. Then 32% of any earnings between $1,024 and $6,172. And then 15% of any earnings over $6,172. So what you can see is there's a higher rate of replacement for a lower earner, a lower rate of replacement on the higher earnings. So that means if somebody lived in poverty their whole life, they earn $900 per month, they're going to have an $810 Social Security benefit because they're going to get 90% of that first bend point. So these don't change. The 90% to 32% to 15%, those do not change. These numbers right here go up each year based on inflation, based on the cost of living.
Hey, John, can I interject real quick if you want to go back one slide?
Mm-hmm.
You know, just for any business owners out there, I mean, this is really a subject as far as how this retirement benefit is calculated, that we actually have done a good amount of planning around. Typically, you know, an S Corp, the owner of the S Corp may actually want to set their salary, and it has to be a reasonable wage, but this is an opportunity to take a look at what that current salary is, what that increase or decrease in salary could do to their Social Security benefit. And we have had some instances in the past where, you know, adding salary, just depending on the amount of work and the number of years that they've accumulated, actually increasing that salary has not increased that Social Security benefit, you know, especially in those early 60s, those last few years of work.
That's a great point, and I want to add that Social Security won't help you with those types of questions. Pretty much Social Security will take your claim when you're ready to file the claim, but they're not going to get into, you know, budgeting, planning, those types of situations. The next slide actually, you know, speaks to that. It's quite frankly the most common question that I would get asked as a Social Security representative. And when do I start my Social Security? You know, what month do I start it? Do I start it at 62? To age 70. If you take it at age 62, you're going to get 75% of your full amount. And it goes up by about 0.5% for each month up to the full retirement age. In this chart, the full retirement age is assumed as 66. Although that might differ for other people. And then 8% is added on for each year after age 66. So the range is 75% to 132% of the benefit. And everybody seems to have an opinion on when the best time to take the benefit. And to me, it's always been one of those very personal choices. Unless you can tell me the exact day you're going to die, you know, it's very hard to, you know, tell you when to take your benefit. But you know, they offer a great service at HBKS where they actually will, you know, review your benefits and plug numbers into software that they have, which will suggest the best times for you to take benefits and your spouse to take benefits.
Yeah, thanks, John. And I'll just comment on that. I mean, I think that's probably it is the most common question we get, right? And no one knows that right answer, but I think what we can do is just best foot forward, right? And try to give you what we feel are the maximization strategies, depending on age differences between husband and wife, earnings history on husband and wife. Sometimes it may be better to take the lower of the two benefits first to hedge that longevity risk. But really every situation is specific to that individual.
This is just another chart that kind of shows what the reduction factor would be at different retirement age. So if your full retirement age is 67, if you're born after 1960, 30% reduction from age 62 to age 67, whereas 25% reduction from age 66. My grandparents, whose full retirement age was 65 years old, their reduction was 20%. Okay, so they didn't move the minimum retirement age. When Congress changed the laws about the full retirement age, which was done in the 1984 amendments, they didn't affect the early age retirement, just the full retirement age. And this chart right here, we're going to get more into spousal benefits. I know there's lots of questions on spousal benefits, but this just gives you an idea of what the reduction in the spousal benefit would be. If you have not visited our website and you're close to retirement, there's a wealth of materials on there. We have a retirement calculator that gives estimates based on your actual Social Security records. There's different, you can use the retirement calculator if you have enough Social Security credits. So if you're not insured, it's not going to, that Social Security calculator isn't going to work for you. Also, if you're not currently receiving benefits or have applied and awaiting a decision. So it's really for pre-retirees before you have actually filed. A good tool on our website. And there's a number of planning tools that I've provided you guys links to that I would advise checking out. So it's become very common, more so today than probably any time throughout my career in working with Social Security. People don't actually retire. Maybe they stop working in one job, maybe they start getting their Social Security, but they still continue to work. So how do you work while receiving benefits? Well, basically, if you're under your full retirement age, and let's just say full retirement age 67, we'll use that as the number. If you're under the age of 67, you can earn $19,560 per year. For every $1 you earn over that, Social Security will withhold $2 from your benefit. So if you earn $1,000 over that and you have a $500 a month benefit, Social Security is going to withhold your first $500 Social Security check. The year that you reach your full retirement age, so I was born in September, the month that I achieve my full retirement age will be September in the year that I turn 67. So from January through September of that year, I'd be at the second tier of the earnings test, which would be about $52,000, $51,960 specifically in 22. And then it's $1 for every $3 reduction. That tier varies for everybody. If you were born in February, your earnings test is just for January and February. You're allowed to earn that full $52,000 just in January and February before any reduction on your Social Security. You may have heard people say, check into Social Security in January of the year you're going to retire because you might be able to get a benefit from it based on second tier of the earnings. Once you've reached your full retirement age, there is no limit to what you're allowed to earn. Okay? And by the way, while you're working in retirement, if you're earning more than one of your top 35 years, you'll automatically get an increase in Social Security. So that happens very commonly as people continue to work and receive retirement benefits. The retirement benefit is a living, breathing thing that isn't, set in stone the moment you file. If you work more and you replace your lowest of your 35 years, you're going to see an increase in your benefit. Okay, this just gives a little illustration. I'll just kind of linger on this slide for a minute for people who are younger than their full retirement age during 2022, what they earn and what their benefit would be. By the way, we ask people a question on the application if you're working. So we rely on our customers, or Social Security customers, to report to Social Security what they are earning. If it changes during the year, like let's say you really are planning on retiring, but go back to work for some reason, you can actually contact Social Security and they'll change your estimate. Some folks are in commission-based sales and change their estimate several times during the year as they make sales or they don't make sales, and we can adjust on the fly. At the end of the year, at the end of the calendar year, when all the earnings are done, if you have estimated low, you're going to end up being overpaid, meaning Social Security is going to have paid you too much money, and Social Security is going to ask you for that money back. If you estimated high, in other words, you told Social Security you earned too much, there's going to be an underpayment that Social Security would pay out to you. Okay, benefits for the spouse. So, basically the spouse is a gender neutral term. So everybody who's married is a spouse, husband and wife, and the benefits go both ways. And quite frankly, when you apply for Social Security and you tell us who you're married to, basically you ask, who are you married to? And you let us know. The computation for spousal benefits is done automatically. Okay? The maximum spousal benefit is 50% of the worker's unreduced benefit. So if you have a worker and a spouse, the spouse is also a worker. Okay? The worker is also a spouse. So you compare both ways. If the spouse takes the benefit early, regardless of when the worker retires, there will be a reduction. So the spouse would receive the full 50% of the worker's unreduced benefit at their full retirement age. Basically, if the spouse's own benefit is less than 50% of the workers, they will be combined to equal 50% of the workers. So if the spouse's own benefit is $800, if the worker's benefit is $2,000, so 50% of that is $1,000, how that spouse would be paid is they would get $800 on their own record and $200 on the worker's record. If their record, if the spouse's record, let's say, was $1,100 per month and the worker's record was $2,000, there would be no eligibility for spousal benefits because the 50% of the worker's benefit is less than the spousal benefit. Okay? Spousal benefits never affect the actual worker, so it's paid as an auxiliary or an extra payment. In other words, the worker's benefit is never going to be reduced by a spousal benefit. There's also special rules that if the spouse is caring for the child of a worker who's younger than the age of 16 or disabled, and then that benefit is unreduced. And spousal benefits are not payable until the worker collects. Is a triggering event for spousal benefits to be. Divorce spouses.
John, can we go back to that for 1 second?
Yep.
Yeah. So, in this, we just two planning things that are planning items that we typically see. First off, if we have a spouse that maybe hasn't worked or hasn't had all the quarters and isn't fully insured, this working spouse, it'll push them to draw their Social Security maybe closer to full retirement age because of that last line here on your slide. The spouse benefits are not payable until the coworker collects. So in some instances, what we do see is it'll actually disincentivize one spouse to defer their Social Security to age 7 if the other spouse is dependent on their benefit. Okay. So it's something that it's, again, specific to each individual situation. But a lot of times someone will come in and say they'd like to defer till age 70. But when you look at it a little deeper, it may actually pay more or at least hedge that longevity risk again to take it earlier because we know the spouse will begin their benefits at the same time.
Thanks, Steve. That's great. Divorce spouses. Divorce spousal benefits work exactly the same as spousal benefits, except the duration of marriage has to be 10 years. So the duration of marriage for spousal benefits is 1 year. The duration of marriage for a divorce spouse benefit is 10 years. So I always tell everyone, if you're in a bad marriage for 9.5 years, hold on for that last 6 months. There might be a benefit at the other end of it. Same qualifications, so ex-spouse has to be 62 years old. The one difference is there can be independent entitlement. So a divorced spouse can file on a worker's record even if that worker has not filed for their own Social Security yet, as long as that worker is eligible to collect Social Security, meaning as long as they are 62 years old or older. That prevents a spiteful divorced spouse from not filing their claim just to keep their benefits away from their ex-wife or ex-husband. Survivors benefits, and we do whole seminars on survivors benefits too, but I wanted to touch on it because I saw some questions that came in on survivors benefits. But basically, survivors benefits are under the umbrella of Social Security, okay? And they operate similar to retirement benefits, meaning they're age-based. So at a full retirement age, you receive 100% of the deceased worker's benefit. At age 60, 71.5%. So it's not 62 to full retirement age, it's 60 to full retirement age for widows and widowers. And if a widower and widower is disabled, they can actually file as early as 50. Okay?
John, I'm going to jump in here again. This is actually probably one of the most popular calculations that we do for our clients. You really want to pay close attention to your own benefit and being able to maybe defer that one to age 70 while you're taking your survivor benefit in between. And typically the crossover for waiting to age 70 is much lower when we're dealing with survivor benefits than we were with just traditional Social Security retirement benefits for an individual.
Yeah, so just I jumped ahead to kind of talk about what you were talking about and why this computation is so important. And widows and widowers have an additional level of planning. I highly encourage you to talk to Steve, talk to somebody at HBKS if you are a widower or widower to get your planning right. My mom was widowed. Okay, she was widowed early. So when she turned 60, she took my dad's Social Security benefit. She got 71.5% of his benefit. My mom also taught for a number of years. So she was insured on her own record as a teacher. She lives out in Denver. She loves that I talk about her on seminars like this. When she turned 70 a couple of years ago, she contacted her Social Security office out in Denver and switched the benefit over to her own record. So that's exactly what Steve is talking about. She took the lower portion. She was fortunate enough to be able to take a lower amount of money at age 60, continued to collect that benefit while her benefit grew, and then she could have also diverged. She took at age 62 and took my dad's widow's benefit at age 60. Okay, there is no delayed retirement credits. There's no add-ons for delaying a widow's or survivor's benefits past the age of 66. So you really want, if you have the ability to plan or delay your Social Security, you want to make sure you end up with the highest possible benefit for the longest period of time. And widows, survivors are able to do that. It's a valuable resource. Jumping back, I want to talk about children a little bit, because if you have kids or if you have a disabled child, your kids can get benefits on your record. Basically, if you have a child who's under the age of 18, or if they're still in school up till 19 and 2 months, and you're either retired or, if a parent is deceased, that child can receive basically 50% of the parent's full benefit in a life situation, 75% of the parent's benefit in a death situation. If the child is disabled before the age of 22 and remain unmarried, we refer to those folks as disabled adult children. They're largely our permanently disabled population, folks with Down syndrome, severe cerebral palsy, et cetera. They can receive a benefit based on their parents' work. Okay, I always said this benefit doesn't get talked about a lot. We have the Barber National Institute here in Erie, a large facility that takes care of people who have intellectual disabilities, and those folks are not on SSI. Probably 75 to 80% of them are on Social Security benefit as a result of their parents working. Their parents are sometimes long gone, okay, but they became insured, and their children are still receiving this disabled adult child's benefit. So that child will be protected until they're dead. There's also a $255 one-time payment when a person passes away that goes to the spouse or certain children. And I also like to throw this in just for a fun bit of history. There's also parents' benefits. I've never seen a parent benefit be paid, but back when Social Security started in 1935, there were already people who were 66, 70 years old. And if their children were supporting them and were eligible for Social Security, their parents could actually file on the record of their kids. Everyone has their own Social Security now, so we really don't see that benefit, or I've never actually seen that benefit. Okay, just to keep moving forward here. Will I pay taxes on my benefits? Possibly. Okay. The one thing, Social Security doesn't help with taxes. It's very common for somebody to call up Social Security and say, how much am I going to have to pay, tax-wise Social Security? And that's the last question you want to be asking Social Security. They are not tax people. And if you have anyone that, tries to answer that question, you're probably going to get bad information. Okay. If you file a federal tax return as an individual and your combined income is between 25 and 34, you may have to pay income tax on up to 50% of your benefit. If it's more than 34, potentially 85% of your benefits are taxable. If you file a joint return and combined income between 32 and 44, 50% of the benefits possibly taxable, 85 over 44. And if you're married and file a separate tax return, you're probably going to pay taxes on your benefits. Okay. There's a W-4V. It's a form that you can submit to Social Security, and they'll actually withhold taxes from your benefits if you want that to happen. And you can do that, when you file your claim.
Hey, John, and I'll mention just from our standpoint as advisors, clients should be very conscious of IRA withdrawals when they're taking their Social Security. Because that IRA withdrawal is creating taxable income, and you may be in the 12% tax bracket, for example, but it also would drag your Social Security into that calculation and make some of that Social Security become taxable. And so the client could experience an effective tax rate on an IRA withdrawal higher than what their actual tax bracket is. So there's some planning around here, and just encourage a conversation with an accountant or an advisor before you make decisions on IRA draws.
Thanks, Steve. Just another slide on the taxation of your Social Security benefits. Just let that linger here for a second. We're going to jump into Medicare. I've often said, Social Security and filing for Social Security is foolproof. The application itself takes about 10 to 15 minutes to complete, and every question on the application is designed to maximize your benefits. People file all the time for Social Security benefits. They don't attend a seminar like this. They don't talk to someone like Steve. They go into it blindly. And the scope of the application really does protect folks like that, as long as you answer every question on the application and you're going to maximize your Social Security benefit. I'm not advising to do that, but there is that protection there. Medicare is a little bit different. Medicare requires some timings on your parts, and there are penalties and other things that can happen if you don't time Medicare correctly. There's really only 5 ways that a person can have Medicare. The most common is at age 65. Okay, aged Medicare is what it's referred to. People also get Medicare after 24 months on Social Security disability. There's 3 other ways to get Medicare. If you have ALS, chronic kidney failure, or were exposed to certain environmental hazards, you can bypass that 24-month period and go on to Medicare. But those are the only 4 ways to be eligible for Medicare. Your initial enrollment period is 3 months before your 65th birthday and 3 months after your 65th birthday. If you are already receiving a Social Security cash benefit, meaning you're already getting a check, about 3 months before your 65th birthday, you're going to be sent a Medicare card in the mail, a registration packet to Medicare, and you're going to be basically enrolled. If you do nothing at all, you'll be automatically enrolled on your 65th birthday. And pretty much I would advise everybody to take Medicare on their 65th birthday, unless there is one condition. You are still working and you have health insurance based on that work, or your spouse is still working and your spouse is providing you health insurance based on that work. If you have that condition, you can actually defer Medicare. And once you get that package, you would sign it and send it back to Medicare, tell them that you don't want it. They would send you another card with just Medicare A on it, because you would take Medicare A, which is free, and you would defer your Medicare Part B, and you would use the special enrollment period. The special enrollment period allows people to enroll into Medicare at any time that they lose either any time in a 7-month period after they or their spouse lose their group health coverage or lose the employment that is associated with that group health coverage. So basically, you can defer your Medicare at age 65 if you're working and you have coverage based on that work, and you can pick it up at any time in the future. I once, when I was working at Social Security, I helped a 94-year-old woman enroll in Social Security. She had deferred it at age 65, and then, 29 years later, she finally had stopped her part-time job, which was giving her insurance, and she enrolled in the Medicare. No problem, no penalty at all. However, if she wouldn't have had coverage, if she wouldn't have been, working and had that coverage based on her work, and she would have tried to get into Medicare, she would have had a 10% penalty for every year that she waited to enroll. And she also would be subject to only enrolling during the general enrollment period. And the general enrollment period is kind of the catch-all period for people who hadn't enrolled before. And you can do that every January 1st through March 31st, and your coverage will become effective the following July with, of course, any penalties of the 10% for each year you are out. Okay, so it's very important that you sign up for Medicare at age 65, or you accept that enrollment if you're already receiving benefits, if you don't have employer group health insurance based on current inactive employment. By the way, retiree plans don't count for a special enrollment. So if you're lucky enough to have your employer pay for your health insurance in retirement, you still have to take Medicare at age 65 or face penalties in the future. Okay, it's only for employer group health plan that is based on current employment. So if you enroll in Part B 1 to 3 months before you reach age 65, the Part B coverage reach 65. If you enroll the month you reach age 65, it's 1 month after. If you enroll 1 month after, it's 2 months after enrollments, and 2 to 3 months after, it's 3 months after enrollments. This is important because people are trying to time their health insurance and not have it broken. So if you're trying to file for Medicare 2 months after your 65th birthday, it's possible you'll have a break in your enrollment. They're not going to retroactively go back to your 65th birthday. The premium, sometimes, you might get a letter in the mail from Social Security that will tell you you owe more money than the standard premium. So it's possible that if the Medicare premium is standard for everybody, so it's $170.10 in 2022. However, if you're an individual that earns or that has modified adjusted gross income of $91,000 to $114,000, they're going to add $68 onto that premium. This is also something to plan with folks like Steve with, to make sure that your IRA contributions, pension contributions, rolling IRAs over, all the stuff that, is independent of Social Security, but can affect what your actual Medicare premium is. And Steve, I'm going to let you talk on that for a second.
Yeah, this is a great slide, and we tend to do this a good amount through the year for our clients. Again, I think IRA withdrawals in retirement can have a very significant impact on this. Sometimes we can't get around it with required minimum distributions if those are significant. But I think just having a little bit of foresight and doing that planning throughout the year, you don't want to get caught with this. And then, John, maybe you can speak a little bit about, they go back 2 years, right, to calculate this premium. So whatever your income is. Go ahead.
Yeah, they look at the most recent income that is available, and that would traditionally be, with interfacing with the IRS, because Social Security gets the information based on tax returns from the IRS, and it's generally 2 years ago. The IRS was very behind on processing returns during COVID, so that was causing problems where we were using old returns because that's the only data that we had, and the triggering event is when the person files for Medicare. Once you get the letter, make sure you carefully read the letter, because it's possible we're using old data, and you can submit new data to us, or you can there's some other information. I don't want to get too far into the weeds. You can submit new information about your new income in a more current year that can erase the IRMA premium, the additional premium that's added on to high earners.
I'm going to just mention, John, thanks. And there was a question that came in, and I just want to make sure we're clear. When I'm talking about IRA withdrawals and retirement, I'm talking about taxable pre-tax IRA withdrawals. The question that came in was in regards to Roth IRAs. And so a Roth IRA withdrawal would be more favorable in these situations, right? Because it's not increasing that income.
Right. Some people to continue down the Medicare path. Some people are working at their age 65 and they just want Medicare Part A. So you can file for Medicare Part A directly through the website, Part A only, not take your Social Security benefit. And if you want to get Part B, okay, you already have Part A or maybe you already have your retirement benefit. When your coverage is ending, when your group coverage is ending, or when you're retiring from your job, you want to submit to your local Social Security office the forms CMS 40B and CMS 564. You can find those forms online. I recommend faxing them to your local Social Security office because they are time sensitive. So you want to make sure you get that electronic stamp on it. And you want to do that about a month before, about 45 days before you're either losing your job or you're losing your health coverage. So again, CMS 40B, CMS 564, this will get you Part B when you already have Part A. So you've deferred Part B because you're working. Okay, you fax those to your local Social Security office, and you can find the fax number for any Social. There's 1,330 Social Security offices. Contact info for any Social Security office on the website through the Social Security field office locator based on your zip code. Okay, their jurisdictional Social Security offices are jurisdictional based on zip code. I threw this slide in here because it's new. Social Security doesn't change a lot. Honestly, it takes an act of Congress to change Social Security. So, we're very slow moving and don't change a lot, but this is something that's new. Effective 2020, they're allowing individuals to advance designation of a representative payee. So a representative payee essentially is an individual or an agency that is assigned by Social Security to somebody who cannot manage their own benefits, is not capable of managing their own benefits. For instance, children who receive Social Security benefits have representative payees. A person who has Down syndrome might not be able to manage things themselves, so they may have somebody who has been assigned to them by Social Security. We also see it, people age into it. My grandmother got Alzheimer's. She was sharp as a tack until 90, and then from 90 to her death at 94, there was just a decline. And she could not do things like manage her Social Security or pay her bills. So one of my uncles served as her representative payee. It's sometimes hard when there's family fighting over people or people who have competing interests. You can now tell us who you want to be your preferred rep payee if you ever end up in a situation where you need somebody to help you. So I advise everybody to, you can do this in the claim, or you can actually contact Social Security and say, hey, I want to put in my advanced designation of a rep payee. But that's something that you're going to be seeing around, and I would consider it and make sure you get a trustworthy person on there. It makes the Social Security decision-making process of who they're going to assign, if needed, that much easier when we know the wishes of the individual while they were still of sound mind. Okay, how to apply for benefits. So you've talked to Steve. You figured out when you want to apply. You figured out when when your Medicare is going to start. You know when your spouse is going to apply. You've got all your timing down. There's really 3 ways to file an application. Okay, you can do it directly on the website. Social Security wants you to do it on the website. They're short-staffed. They have long waits. So they're pushing people to file on the website. I, as a representative of Social Security who promoted people filing on the website for years, I think that it's a fine tool. But I also believe it's not for everybody. If you don't have a lot of questions, if you know what you're doing, you know your date that you're going, you don't have any weird scenarios in your background. So when my mom filed her widow's claim, my family grew up in Canada. So my dad was also insured under the Canadian Social Security system. So, that had to be dealt with during the claim. If you've got something unusual in your past, like maybe you worked in another country, or, maybe you took a vow of poverty and were a missionary for 20 years, it's just something that's not your typical, here's my work scenario, here's where I'm going to take benefits, you might want to consider, instead of filing online, scheduling an appointment. And you can schedule an appointment by calling. That's the 800 number displayed here, but you can also call the local office, or you can walk into your local office. If you are going to use Social Security's in-person services or phone services, prepared to wait. They're not good at answering the phone. They're not good at, dealing with people in person. You will get through to somebody, and you will get through to somebody who works for Social Security, but you better, take some time, have a good book to read if you go into the office, because you're going to wait a couple of hours. You also want to time it. If you want an appointment, the appointments are generally being scheduled in Erie about 6 weeks out, meaning if you call them today, the first available appointment for you isn't going to be for 6 weeks. Now, when you call Social Security and make an appointment, even if they don't have an appointment for you for 6 weeks or so, it's going to be like you're filing the day you filed the appointment. Okay, so they're not going to disadvantage you, by moving your filing date back simply because they didn't have an appointment. So again, you can file directly through the website. Click on File for Retirement. It takes about 10 to 15 minutes to complete that application. You can call your local office or the 800 number and get an appointment to file for retirement, and that can be done either in office or over the phone, or you could walk into your local office, be prepared to wait, and get an appointment that way too. Again, appointments are about 3 to 6 weeks out. Here's our website. If you haven't seen it yet, again, I would check it out. And I really advise everybody, to set up a My Social Security account. If you haven't done this yet, this is so valuable. This gives you access to basically everything that a Social Security employee has about your Social Security record. It's something that I wished for my whole career. It came about probably 8 years ago, and it really gives control of people's Social Security to them. So when I log in, I have a My Social Security account. When I log in, I see my earnings history. I just check it every year because I know that Social Security earnings are reported. I want to make sure my earnings are getting reported each year. I've seen multiple times where a person's earnings records are incorrect because their employer reported their earnings incorrectly. So it's a lot better to have all that stuff straightened out, look at your earnings, know what you're going to receive some Social Security prior to filing. Once you file your claim, your My Social Security account turns into almost a Social Security dashboard where you can manage your own benefits right through the website. Social Security is difficult to contact. I've said that several times. Through your My Social Security account, you can do things like change your address, request a replacement 1099 form. Sorry, that slide just advanced. Request a replacement Medicare card, get a benefit verification letter, change your telephone number, change your direct deposit, all the small things that you don't want to wait an hour or 2 hours on the phone to talk to a representative, you can do directly online. And it is a multi-faceted authentication. So basically, like most of the things that you're creating accounts for, we're verifying your identity. If for some reason, personally, I had no problem with it when I set up my account, and numbers of people have set up accounts. If you are one of those people who, for whatever reason, can't set up an account, if you contact Social Security, they can give you a special code that allows you to set up that My Social Security account. Okay, and I think we have some time for some question and answers, maybe, Steve?
Yeah, we got about 10 minutes left. If Lori and Megan, if you guys girls have some questions tagged, we can go through them.
Yeah, we got a lot of questions in prior to the session, and a lot came in while the session was going on. So, John, I'm going to start firing them off. After you turn 66, what is your first full benefits month, and then when is your first direct deposit payment?
The month after, so you achieve 60, Social Security payments are paid, so that you achieve age 66 the month after, so you'd be 66, and the first month that you're 66 for the full month, and then Social Security payments are made 1 month off. So we're in June now. The Social Security payments that are being made this month are actually for May. Used to be all Social Security payments were paid on the 3rd of the month. Now they're paid based on when your birthday is. So if you're born on the first 10 days of the month, your payment will be the second Wednesday of the following month. Second 10 days of the month, it'll be the third Wednesday. The last 10 or 11 days of the month, it'll be the fourth Wednesday of the month.
Hey, John, on that initial application, that first payment you receive, is it the first 2 months? Do they pay that together?
It would only be if the application is processed retroactively. So, yeah, generally they're not paying more than 1 month of payment. There are scenarios where a person has retroactivity where maybe more than 1 month would be paid, but generally not.
Okay. Next question. Yeah. What are the implications if I sign up for Social Security while I'm still working?
Well, we covered that. It's just important to tell Social Security. It's on the website, or excuse me, it's on the application. So, you know, we're asking you when you file. And if you go back to work, you just have to let Social Security know. The specific customers to bargain with them in good faith. Okay. In other words, try to accurately let them know what they're going to work. There's possibly going to be overpayments or underpayments. As long as you're not playing games. And what I mean by playing games, I actually witnessed cases where, you know, we saw people who had over $100,000 in earnings who were consistently telling Social Security they were earning zero to receive the full check, and then they would be filing waivers on the overpayments, et cetera, et cetera. If Social Security thinks you're doing that, they can actually apply additional penalties to you. Now, that is really rare. Just bargain with us in good faith. Be as honest as you can about your work. Contact Social Security if your work changes.
And I'll jump in real quick, John. I mean, I think if you're under full retirement age, we just have to be really conscious of what your income is. You know, if you're over full retirement age, we want to be conscious of income more for taxes, but not for a reduction of benefits.
Right. Got it.
Okay. If you're working and over 65, is it better to wait to collect higher Social Security at a later age, or go ahead and collect it and invest until needed? Well,
I think talk to Steve, honestly. My dad died when he was 51 years old, so, you know, it really becomes personal. I want to get my Social Security as soon as possible. There's other people who want to wait until age 70 and will tell you that's the proper way to do it. They'll make a comprehensive plan for you and will tell you, here's what we believe the best time for you to file, and here's why.
Yeah, and I'll speak to that real quick. I mean, I think when we're completing our planning with our client, you know, we can run those scenarios, but we have to take into account what you'd be receiving at that younger age versus what you would receive at that age 70, for example, that increased amount or decreased amount. We also want to factor in taxes, you know, and then take that net number and invest it. And we would have to put on some sort of projected rate of return and see what that crossover is. You know, adding a rate of return or investing those dollars in the meantime, taking it early, it really depends on how well those investments do, right? You know, because that can actually have a huge impact on what that crossover is. The typical crossover, though, John, if we're not investing it, right? I mean, if you compare from full retirement age compared to deferring to age 70, we're usually looking at between age 77 and 78 for that crossover, correct?
Right.
And so the client, yeah. And so if the client lives past age 77, you know, if we take out the investment portion of that conversation, if they live past 77 it would have paid to wait. If they take it early and someone were to pass before age 77, then it would have paid to take it a little early.
Yep.
Goes back to your crystal ball comment, John.
If you tell me when you're going to die, I can tell you when you can file.
That's right.
Okay, we got a couple of questions along this vein. Can you max out your Social Security contributions?
Yeah, 35 of the max years. You can, once you've had 35 of the max years, there's a maximum Social Security. If you were to just Google maximum Social Security 2022, you'd see what it is. So just based on if you understand the calculation, based on those 35 top years, once you get 35 of your top years in, you are maxed out, meaning your full retirement age benefit isn't going to increase any further. I'll address this too, because I saw this question several times. Cost of living, you don't have to worry about filing to get the cost of living. The cost of living is built into the computation. So those bend points that I told you where they change each year, where you get 90% of the $1,024, those change based on whatever the COLA is that is given to beneficiaries. So the cost of living is built into your unpaid benefit.
Hey, John and Lori, can we touch on solvency? Because I know we're kind of running up against an hour here.
Mm-hmm.
I saw that question come through, and I think it's an important topic. If John wants to give us his 3 or 4 minutes, I know he could spend probably 2 hours on it, but we'll give it the highlights here.
Yeah, sure. I've always said the biggest question I would be asked as a speaker is, when I should take my benefit. The second biggest question I would be asked in some form or another is Social Security going to be there for me? Like, will it be there when it's my turn to take it? And, I fully believe 100% yes. In fact, my answer was always like, unless we're fighting each other for food in the streets, Social Security is going to be there. Like, we're part of, Social Security through the system and paying benefits. Now, solvency itself gets a little complex. Like, our worst case scenario, Congress does nothing at all to tinker with the program. Come 2034, Social Security will be able to pay about 78% of the promised benefits. They'll have to start borrowing. 2027 is when the bonds or the interest on the bonds that they own will be exhausted, and they have to actually start cashing in bonds, right? Which is the government owns. So it's weird that Social Security invests their money in treasury bonds. So, their assets are the government's liabilities. So I don't think the government wants to get into a situation where Social Security starts cashing in their bonds. Historically, and again, I've done 2-hour-long seminars on this, but historically, if we were in 1979 right now, we had already borrowed against, for the last 13 years, we had been borrowing against the general tax revenue just to pay benefits. There's a number of changes throughout the 80s that overhauled Social Security. It raised the retirement age to 67, full retirement age 67, cut benefits to young mothers and college students, raised the tax rate from, I think it was 4.1% to 6.2%. So there's a number of changes that, made us solvent for many, many more years. And it really does become, how you want to fix Social Security. There's all sorts of different ways that people have suggested it. And I'm assuming that the politicians will come together and, come up with a solution to keep the program solvent. We're one of those weird programs where it's, maybe other than the military and the post office, where, we serve everybody in America. Baby's born, they get a Social Security number, someone dies, and Social Security is screening them for widow's benefits. So it's one of those programs that touches everybody, and everyone seems to have an opinion about it. Everyone seems to have ownership of it. If you really are interested, I'll say one more thing. Social Security has an actuary, a brilliant man by the name of Stephen Goss. And if you're really interested, you can listen to one of his webinars. He's just, will make your head spin. But he has all these charts on the webpage which are mathematical, and they address the 13 most common suggestions to change Social Security. Everything from very liberal ideas of expanding benefits to some conservative ideas of investments in private markets, et cetera, et cetera. And just basically looking at how that impacts Social Security's bottom line. And you can find that on the actuarial page under the research and statistics section of the Social Security website.
Thanks, John.
Thank you, John, and thanks for sharing your experience and insights today with us on Social Security. We hope today's session has been informative and helpful. We encourage anyone attending today's session to visit our website for an overview of HBKS services and insights on a wide range of financial topics from HBKS thought leaders like Steve and others. Also, please don't forget to complete your survey to provide us feedback on future webinars. If you have additional questions, you can submit them via the survey through our website at hbkswealth.com or the Contact Us form on the bottom of your screen. And again, as a reminder, we are offering a complimentary financial review for anyone attending the session. Thank you again to John Johnston for his insights and Steve Rinn for hosting. And thank you all for attending today's session. We look forward to hearing from you.
Thanks, John.
Hey, thanks, Steve. Appreciate it.